Let's get started. As everyone knows, my name is Michael Petraka. I'm the owner and operator of HJP Financial Group, and tonight's presentation is going to be on tax strategies. Now, I would say in my 15 plus years of doing this, which is just crazy for me to say, if I were to think of one area of financial planning that I consider the most important in terms of building wealth, between understanding markets, the economy, insurances, investments, estate planning, long-term, it's understanding the tax code is the easiest way to increase rate of return. People focus way too much, in my opinion, on trying to predict where markets are going, and they leave a lot of money on the table, not because they can time markets getting in and out, but by just understanding the tax code and understanding where to put what investments, when to process different strategies. You get very good at that. That's a very easy way of really increasing rates of returns over the time, a very meaningful 1, 2, 3, 4% over time. And if you're able to increase rate of return by 1, 2, 3% over 10, 20, 30 years, that makes a dramatic difference in someone's net worth over time. So tonight, we're going to not go very deep in any one particular subject. My goal is there might be one or two strategies that you may believe could pertain to you. We can have a follow-up conversation, how it works, what are the possible domino effects, what are the other ways that could be positive for you, for negative for you. So please, and I'll bring up my little disclosure statement real quick. This disclosure, more or less what I want to say here is please do not implement anything I say today tomorrow. Every single thing you do has ripple effects that could impact something else. So certainly, like I said, if you think one or two of these things apply to you, I'm happy to sit down, analyze it, really make sure it makes sense based on your financial plan. In saying that, there is a chat box that if you have any questions, I'm happy to answer them throughout the presentation. Feel free to stop me at any time. Of course, at the end, I'll be happy to answer as many questions as you'd like. So for tonight, I would like to get everyone to have a understanding of kind of tax planning 101, just have a basic understanding. 2, I'm going to go over some recent legislation that Congress has passed. 3 and 4, it's really just having an understanding that, this is kind of like a Rubik's Cube, that you're trying to solve the most efficient way of doing something. And then 5, kind of next steps from there. Now, one thing I want people to realize is, the system is not simple when it comes to the tax code. I believe if you were to stand the tax code up as a document, it's be about 6 feet tall. There's a whole bunch of gotchas that you have to kind of worry about. So it's not a straight line in terms of your progressive tax. It's not a simple situation. Sometimes you can be watching to make sure you're in the right tax bracket, but you didn't pay attention to your IRMA for Medicare premiums, or Social Security's now become taxable. Now you triggered a taxation for Social Security or a property tax freeze. So this is why, like I said, it's kind of a Rubik's Cube of like multiple different things that we kind of have to look out for. So first and foremost, always like to kind of highlight the tax brackets. So we have a progressive tax system in this country, which simply means the more income you have, the higher the tax bracket becomes. So if we go through a simple example, let's say we are a single individual, and let's say we have income a little over 100,000. So that's putting us in the 24% tax bracket. So let's just use a round number of 100,000. What I'm not saying is, you found yourself in the 24% bracket and you have 100,000 of income, so your tax is 24,000. No, a progressive tax system simply means you're going to get hit a little bit at each step of the way. So for example, at 100 grand, the first 11,599 would be taxed at 10%. Then between 11,600 and 47,000, you'd be taxed at 12%. And so each level of income you have, you would have more and more of a tax bracket hit that level of income. So Something to keep in mind is you may hear the terms marginal tax bracket and effective tax rate. So like in the same example of, let's say our income for single was 101,000. So that's putting us in the 22% bracket. So your marginal tax bracket is that would plop you into the 24% bracket. So your marginal tax bracket would be 24%, but you would have very little income, taxed at that 24%. Your effective tax rate is, let's say, on your roughly 100,000 of income, you effectively had 18,000 of a taxation. So your effective tax rate, since we're using a nice round number of 100 grand and you paid 18,000 in taxes, your effective tax rate would be 18%. It's more or less the blend of all of the taxation of the incomes at different levels. Now, something we always have to keep in mind, and I'll go into it later in the presentation, is the tax code and the tax brackets are not simple and equal installments up. So as you can tell, there's two big leaps when it comes to tax brackets. The jump from 12 to 22, which is almost a double. It's something I'm cognizant of for almost all of my clients because a lot of these individuals are pretty close to that level of a budget. And then, of course, the 24 to 32. So if I'm sitting here and I'm making a decision that might bump my income from the 22 to 24, I might not really think twice about it. But if something is, all right, we need $5,000 and it's now December of the year, and if we take it from the IRA, well, we're normally taking it at the 12% rate, but because we took an extra 5,000, it's going to bump us up in a tax bracket. Maybe that jumps to 22%. So having an understanding of where your taxable income is can help you make a determination of, should I take it from my IRA or 401k? Should I take it from my after-tax account? Should I take it from my Roth? You know, these are things that you're constantly thinking of throughout the year. Social Security is also taxable because, frankly, the government's broke and they need every last penny that they can get. So Social Security wasn't taxable in the past, but they changed it, I believe it was 30, 40 years ago at this point. So how is Social Security taxed? So it's taxed based on what's called your provisional income. So what's included in that number is what's called your modified adjusted gross income. So think of your normal AGI and add back a few items. So something that's not normally counted as income, such as municipality bond interest, gets added back into this. Every other type of income you can think of, rent, earned income, dividends, interest, all of that would be factored into it. So they take that number plus half of your Social Security. So half your Social Security plus your modified adjusted gross income equals your provisional income. Once you have that number, then you can go into the chart below. Now, based on different income levels, determines your taxable income associated with Social Security. So, for example, let's say you're married filing joint and your income is falling between this 32 and 44,000. That means up to 50% of your Social Security benefit will be taxable. What I'm not saying is, let's say your Social Security benefit was 10 grand and we're saying 50%, so the tax is $5,000. No, what I'm saying is if your Social Security benefit was 10 grand, half of the Social Security benefit is $5,000. $5,000 would be added onto your taxable income and would be taxed at your normal tax rate. So let's say we're in the, not that it exists, let's say 20% is our tax bracket and we have $5,000. That means $1,000 would be the tax you would owe on the total $10,000 of Social Security benefit you received. Now, this great Social Security calculator, literally if you just Google Social Security calculator, there's real easy ones that you can plug in. What's my income? What is my Social Security? And you can find your sweet spots of how much of your Social Security will be added onto your taxable income. Now, this is one of those, oops, we got you. So everyone in this country is subject to Medicare. Medicare kicks on at 65 years old. So most people who have their Social Security turned on, the Medicare premiums are coming right out of your Social Security. Now, your Medicare premiums are based on your income. So let's say we're married filing joint and our income is 206,000 or less. Then we're just paying the base rate for our Medicare premiums, which is $174. Now that's times 2. This is a good chunk of change. This is very kind of important to factor into your budget, because what you see from your Social Security, say, oh, I'm going to get 35,000. Okay, it's great, but you have to knock off a couple grand associated with the Medicare premium. So it's one of those gotchas that most people don't plan about, but you have to factor it into the equation. So let's say our income was $206,001. That means now our Medicare premiums for the next year jump from 174 to 244. That's roughly a 40% increase. That's no joke. So, and that's not only for one person, it's both people. So this is a very, very important one for people that are floating real close to these numbers. Like I said, married, filing joint around 206 income. If you're close, you want to be very cognizant of, all right, that next dollar I need to take, do I take it from an IRA or 401k, or do I take it from my Roth account? From Roth, it won't have any impact. From the IRA, it's taxable income. So again, we have to know where these are and kind of be prepared to massage our budget around them. Senior property tax freeze. So this is another one that's kind of a cliff. If you go over it, you lose the ability to freeze your property taxes. So I was always given the example of my grandmother in the past. My grandmother was able to freeze her property taxes at around 3 grand. Now, when she eventually passed away about 20 years later, and the property tax freezer went away, it was 15,000 of property taxes that we had to pay going forward. So this is a very important benefit that you want to be cognizant of. So right now, the property tax freeze is around 163,000 in the state of New Jersey. So if we're under that, you have the ability to freeze your property taxes. Now there's 3 or 4 little stipulations. If you're in a townhouse or a condo, there's other kind of rules. So this is one where I'm just really giving you this piece of information, but certainly you can do your due diligence and I'd be happy to help you do it. But this is one where you don't get a do-over. So let's say in my grandmother's situation who locked it in at 3 grand and 10 years into it, where her property taxes would normally be, let's say 8 grand, all of a sudden she had a big year in terms of an income. So let's say what happens a lot of times is, let's say you sell a stock and New Jersey considers all income the same, whether it was earned income or from sale of a stock or interest from a CD. So let's say you're freaking out because the market's going crazy and you want to sell out of this stock that you hold for 30, 40 years. All that capital gain gets added onto your income. So you get put above this threshold for even $1, then boom, your property tax goes away, or property tax freeze goes away. Now in my grandmother's situation, she would go from 3 to, let's say, the 9 grand, and now she's locked in 9 grand going forward. So you want to be very, very careful if you're coming close to those numbers. Now, this goes back to what I was saying before. In most of the time, your ability to beat the market or time the market is very hard to pull off. But if we have money sitting in a joint account where we have a partner, not only one partner, but 2, that's Uncle Sam in the state of New Jersey. And every dollar we earn in interest, they have their hand out, they want a piece of it. So let's say we have this money sitting in a joint account and we have the ability to fund a Roth IRA. What's a fancy way of saying we get to get rid of our partners? And now we get to put the money in an account that's tax-free growth for all of time. So every time we have the ability to put money into a 401k, into an IRA, where we at least get a tax deduction, or into a Roth, where it becomes tax-free growth, or an HSA, a health savings account, an FSA, a flexible spending account. We want to take advantage of these opportunities whenever we can get them. We always want to fill up our buckets. Now, especially when you're in retirement, it's harder to do so. But something that comes up a lot is, let's say you retire and you do this little side gig where you make 7 grand of income. Beautiful. Now we can move 7 grand from your taxable account or joint account into your Roth IRA. Beautiful. Now 7 grand, we got rid of the partner. And that partner, between capital gains rate for federal and for state, it might be 25% going away to taxes. It's very hard for me to generate 25% rate of return. But by just moving some money from bucket A over to B, we improved our rate of return by 25%. That's a very big deal. So please always thinking about filling up your buckets anytime we have earned income. There isn't too many tax law changes. A few years ago, Trump enacted a whole bunch of tax law changes. There was the Secure Act. There was a few more big tweaks. Over the last year or two, there hasn't been anything too crazy. For RMD, everyone used to be 70 and a half. Now they scaled it to some people at 72, 73, and some people at 75. A nice one that was kind of severe, in my opinion, was if you didn't take your RMD, there was a 50% penalty. That's pretty steep. They now lower that to 25%, and if you do it in a reasonable amount of time, the penalty is only 10%. Another big one, a lot of my clients, let's say, have some money left over in a 529 college account. You now can utilize up to 35,000 and move that money from a 529 over to a Roth. So that certainly helps people who, let's say, had a scholarship or went to a trade school that wasn't quite as expensive as that they were planning for. So that's a nice little feature that they that tweaked. Now, I guess one of the big things when it comes to tax law updates is the tax changes Trump enacted, I guess 4 or 5 years ago, are going to be sunsetting at the end of 2025. And it's going to revert back to the old rules. That's a pretty big deal for anyone in a high tax state such as New Jersey, because we're getting killed right now because of what's called the SALT deduction. That's a state and local tax deduction. So in years past, the standard deduction was like 12, 13 grand. And you used to be able to deduct all of your state taxes. So a lot of people's property taxes are 15 grand. That alone, you're already going to itemize your tax return. So most people in New Jersey who own a home itemize it. Now they capped the state and local tax deduction at 10 grand. And they doubled the standard deduction. So right now your standard deductions for a couple is around $29,000. So most people do not itemize. That all changes possibly at the end of next year. Now, frankly, I'm not even going to be thinking about it over next year. We have an election year. A lot of it will be based on more or less who wins. Because there's probably a high probability Congress does something about it. They could delay it. They could push it. They can, maybe make it permanent depending on if all Democrats are in or all Republicans are in. There's a whole lot up in the air. Probably more or less right now next year, I will have much more of a game plan because we have a much better idea of what'll probably play out. But something to keep in the back of your head. So as you're approaching retirement, and let's say we figured out our budget and we want to spend 100 grand, what we want to be checking in the back of our head is, all right, are we going to be around the Social Security realities? Now, Social Security did not index their numbers ever. So most of the people on this call right now, the taxation of Social Security is just going to be a reality. So it's very hard to pull off not having your Social Security. You have to be in a very low income reality for Social Security. So that probably is not too much of a factor. Like I mentioned before, understanding where the big leaps in the tax brackets, that 12 to 22, and then 24 to 32, we want to be cognizant as we get close to those, or maybe we stop taking from an IRA and maybe we take from our Roth. So tax brackets are a big thing. Property tax freeze, like I said, is not a forgiving thing. If we find ourselves over it, we reset the clock, and now we're going to deal with the higher property taxes going forward. So knowing where those numbers are is very important, and same with the Medicare premiums. If we're $1 over, now our Medicare premiums could be up $60, $70 a person for the entire year. So those are kind of the 4 big ones I want you to think about as you're kind of planning your budget in retirement. Now, as I mentioned at the disclosure, I'm going to go through a whole bunch of strategies. Almost think of this as like a lightning round. I'm going to touch upon it for 2-3 minutes. If something entices you, shoot me an email, give me a call. I'm happy to take a little bit of a deeper dive into it. Like I was just mentioning before, we want to be thinking of tax brackets, Social Security, Medicare, property tax freezes. So as we hopefully get to retirement with a healthy mix of pre-tax and after-tax money. So money, let's say in a bank account or kind of a Roth, meaning it's not going to be taxable to us, our kind of bucket one over here, and our pre-tax money, our 401k, our IRAs, these are places where we're taking a distribution and we're going to have to pay income tax on every dollar that leaves. That we should be having a game plan of your budget of, all right, we're trying to let's say maximize the 12% tax bracket. And based on our budget of, let's say 130,000, that means we're going to take away each dollar that comes out to our budget. Maybe we're going to have 70% come from our 401k and 30% come from our Roth. And if we do that properly, then hopefully we're not impacting our property tax freeze. Hopefully we're keeping ourselves in the 12% bracket. Long story short here, it should be a cognizant decision of we're taking a little bit from each bucket and just a ratio of each. There's a reason behind it. Now, what a lot of people do is and it kind of, I think accountants push this too, is let's try and get your tax bracket really low. So what you do is, oh, I get to retirement, I got all this money in cash. So the first 5 years of your retirement, you use up all your cash. You want to think the long game when it comes to taxation. What works great for you in 1 year, but might set you up horribly for the next 25 years. So most of the time, we're taking a little bit from each bucket. So it's not any 1 year is going to be perfect, but we're going to be able to do things reasonably well over the course of 20 and 30 years. So let's say we find ourselves an example that we've retired at 60, 62, and we got another 10 or plus years before we have to take money out of your IRAs and your 401ks because of the required minimum distributions. Well, that is a beautiful 10-year period of time, but maybe we haven't turned on any pensions yet. Maybe we haven't turned on our Social Security yet. We have no earned income, so we got zero income. So these are fantastic years to take distributions from our 401ks or IRA, our pre-tax money, because we might be paying 0 or 10 or 12% to take the money out. Even if we don't need it, we should take it out and maybe put it into an after-tax vehicle. Or even like in this example, we don't need it, we can just do Roth conversions. So we want to be converting when we got to pay Uncle Sam very little. So years that we don't have a lot of income, fantastic years to take distributions and Roth conversions. This is where a lot of people get in trouble, especially as you start planning at your end of your life. A lot of people say, oh, I don't want a nursing home or an assisted living facility to get my money, so I'm going to start gifting assets to my kids. Now, what you don't realize, especially if you've been in your home for 30, 40 years, let's say you bought it for 100 grand and now it's worth $1 million. Well, if you gift the house, aka deed the house over to your kid, you're also gifting them your cost basis. So let's say they go to sell it. Well, now they have a $900,000 gain they have to deal with. Well, if they inherit the property at death, there's a step up of cost basis. So let's say they inherited at death, so their cost basis is now $1 million, and they sold it for $1 million, the taxable portion would be 0. So now the flip side of that coin, yeah, maybe it's a situation where you want to protect assets for a long-term care scenario or an elder care planning. These aren't decisions that you should be taking lightly. Now, there are pros and cons of both realities, but you got to weigh your risk, your probability, and figure out what makes the most sense for you. But please just don't start gifting stuff away willy-nilly. We want to take things slow and make sure we've thought about all the angles before you do it. The other thing that's probably the best thing to gift to your kids is things that haven't appreciated in value. So let's say you had 10 grand in the bank and you had $10,000 of a stock that you only paid $500 for. If you gift them the stock, you are gifting them the cost basis. If you gift them the 10,000, well, your cost basis is 10,000. So that's a good thing to gift to your kids because there wasn't any tax benefit that you're really giving up. This is a random one that typically happens to one of my clients maybe once or twice a year. Let's say you find yourself in an assisted living facility, and typically they might charge, let's say 10 grand a month, and maybe 5,000, 6,000 of that is medically deductible. Well, that's like having, if let's say this medical deduction port's $6,000, that's $72,000 of a medical deduction you could take on your tax return. Well, we certainly wouldn't want to be, if we got money in the bank account and we have money in an IRA, you don't want to be using the money in the bank. You would rather use the money in the IRA because you could take up to 72,000 out because you have this very nice tax deduction that you can wipe away that income. So if you have high medical expenses, you want to be leaning on touching your pre-tax money, not your after-tax money. So I was just telling you, you wouldn't want to gift your son or your daughter a stock that has a lot of appreciation because you're also gifting them the cost basis. It's the exact opposite for charitable contributions. You would want to give them the stock. So let's say you have a particular stock that you bought for $1,000 and now it's worth $10,000. You can gift that to charity. And now you have a charitable deduction of $10,000. And when they go to sell it, they pay no taxes because they're a charity. So you would never want to cut the charity a check because you're using after-tax money. You would rather give them appreciated securities. So let's say you sold the stock on your side. Well, now you got to pay New Jersey and you got to pay the feds. So maybe you net $7,500 and now you give the charity $7,500. That's a worse deal. So you want to give appreciated securities. Two, like I mentioned before, we had doubled the standard deduction, so it's harder to itemize your tax return. Now, let's say the things you can itemize, charitable contributions, medical expenses after certain thresholds, property taxes. Let's say all these things you added up and you're normally around 27, 28,000. Well, the standard deduction is 29,000. Well, to get to your 28,000, let's say you made $5,000 in charitable contributions. That's certainly a good thing to do, and I will never try and tell anyone to stop doing it. But what you could do is, let's say you normally give it right at the end of the year. Well, why don't you do 1 year at 0 and then give right after the new year, give 10,000. So let's say you did that in 2023, you did 0. So you're just going to use your standard deduction 2023. And because you doubled up your charitable contributions 2024, now you'll itemize your tax return. That's a little sneaky way to kind of bundle charitable contributions. Now, a big way of bundling is what's called a donor advised fund. So let's say you were going to have like one rock star year. Maybe you sold your company and you're going to have $1 million taxable income. Well, in that year, you can do what's called a donor advised fund. So this is an account that you own. And let's say, all right, I only like to give 10,000 to charity. But what you can do, because you know you're going to be in a very high tax bracket in that 1 year, put 100,000 out of the $1 million sale price into a donor advised fund. And then over your lifetime, you could take a little bit out of the donor advised fund every year. There's no requirements, no restrictions, and give it to charity whenever you want. So this way, you got the deduction in the very best year that you had a really high level of income, and you get to still spread it out over your lifetime. Another kind of tricky way of doing it was called directly from your RMD, or a qualified charitable deduction. This is a scenario where, let's say your required minimum distribution is 10 grand. So instead of taking possession of the 10 grand, you have the IRA cut a check directly to the charity. What this does is it automatically doesn't factor in the income onto your tax return. So if your RMD is 10 grand and you went 2 to charity, only 8 would be factored into your income. So that's certainly a fantastic way of using pre-tax money to make charitable contributions. Now, this is a big one that most people don't follow too often. So we have money in a Roth account. We have money in our pre-tax IRAs and 401ks, and we have money, let's say, in a brokerage account. Where you put what types of investments is very important. So let's go over, all right, I got money in an IRA and money in a Roth. Well, Roth is tax-free for all of time. The IRA, I have a partner for all of time. So let's say your level of comfort or level of risk you're willing to take in the stock market is kind of moderate or balanced. So that means we have 50% in stocks and 50% in bonds. Now, the stocks should do better over the time, provide us a higher rate of return. Bonds a little bit more conservative, a little bit more steady. Well, we know we want to be 50-50, but that doesn't mean your Roth should be 50-50 and your IRA should be 50-50. What you would want to do is be more top heavy in the aggressive stuff in your Roth because we want that to grow the most, and be more conservative in your IRA. So again, your overall allocation is still 50-50, but we're top heavy, riskier items, hoping for a higher rate of return in your Roth and more conservative items in your IRA. Now, inside of a taxable account, we really can't be that crazy. You shouldn't be in too many what's called active funds. These are funds where there's a manager trying to buy and sell and do things to generate a better return. You want to be in more ETFs or passive indexes or mutual funds. These should be, you shouldn't have a lot of moving parts. You should be cognizant, of, let's say, you should be more of a buying hold mentality here. What you don't want to do, let's say I bought ABC stock and I held it for 11 months and I sold it. Well, if I waited another month, I would have gotten long-term capital gains treatment, which for most people is 15%. Let's say I sold it within 1 year, so it's short-term capital gains treatment. Well, now let's say my marginal tax bracket's 22%. I just gave up a 7% spread for just not knowing to hold on for a month. So in taxable accounts, we want to kind of be thinking a little bit more long-term. You want to try and get away from a whole lot of trading. We want to stay kind of passive, ETF, and kind of index approached. Again, these are really easy ways that you won't see it on your statement. Your statements will show 8% rate of return or 6% rate of return. But we always want to analyze not my rate of return after I see my statement, because your statement issues tax significance that go over to your tax return. So there's a whole bunch of funds that I could show you that are great pre-tax. Let's say your 8% rate of return, but they just do a whole lot of buying and selling. So their after-tax return might lose 20, 30, 40%. So we just want to be putting the right types of investments in the right vehicles. Tax loss harvesting. So this is the concept of, let's say we have a brokerage account or a taxable account. And at the end of the year, we can look at, well, maybe some of our positions have a loss, but we can simply sell, buy something practically identical. This way we don't miss the market upside, but we got to capture that tax deduction. So at the end of the year, if you have a taxable account, you want to take a look at how much realized gains do I have? Do I have any losses that I can wipe away some of those realized gains? Utilizing Roth conversions. So whenever I'm trying to think about Roth conversions, I think of it as like a 4-quadrant type of thing. Are we in a high bracket? Are we in a low bracket? And then is the market high and is the market low? In the perfect world, let's say I have a $100,000 account. Well, let's say if markets have had a fantastic run and I think stocks are very expensive, maybe that 100 grand is now 120, or maybe the market crashed and it's now 80. You want to try and time conversions when you have to pay the least amount. So I would never want to pay if I thought stocks were literally at all-time highs. I would probably want to wait for a recession or a downturn so I could do that conversion when things are on sale. So in the perfect world is when markets are low and my income's low. That's kind of, I think, a no-brainer. Back up the truck because we're getting kind of a 2-for-1. It's okay if your income's low and maybe markets are high. All right, you got something working in your favor. But you want to be very careful about doing Roth conversions if your income's high and your stocks are at all-time highs. Then you're paying very expensive dollars to process Roth conversions. So bad recessions, or let's say you're younger and you're in between jobs for a year or two, fantastic time to process Roth conversions. Now, these are a couple things you can do, not in retirement, but as you're kind of preparing for retirement. So let's say you're a fantastic saver and you maximize your 401k. What some of the kind of bigger plans allow you to do, let's say the max you can put in is roughly 30 grand. If you're older than 50, I think it's 30,500 now. Some plans allow you to continue to contribute in an after-tax form. And then when you eventually retire, you can move that after-tax money over to a Roth. So it's really a nice kind of extra amount that you could save that acts like a Roth for the rest of your life. So again, the after-tax 401k is when you've already maxed out a 401k. Some plans allow you to continue to save in an after-tax vehicle that more or less acts just like a Roth. And then, you know, when you're contributing, let's say you're doing all that, which is wonderful, and then you can also contribute to an IRA. So let's say you make too much money to contribute to an IRA or to a Roth, there's a backdoor way of getting money into a Roth IRA. Now, this only works if you don't have any other IRA money. If you have 401k money, it's fine, but you can't have an IRA in this particular situation. So I'll use myself an example. I don't have any money in IRAs. All my money's in 401ks. So what I'm able to do is contribute. So I literally just did it for myself last week, contributed $7,000 to an IRA, and I'm not deducting it. So it's a non-deductible IRA contribution. Now there's no income limits on conversions. So I put it in, and the very next day it converted to a Roth. And since my conversion was all basis, because I didn't take a tax deduction for it, none of that conversion was taxable. So every single year, I can't contribute to a Roth IRA, income's too high, but I could do this backdoor Roth and able to take advantage of the tax code that way. Now, again, going back to what I was saying before, let's say I didn't know that trick and I just plopped that $7,000 in my brokerage account. Well, now I got a partner, and that's Uncle Sam, it's in New Jersey, and they're going to take 25% of my winnings. Well, now because I knew this little sneaky code, it's tax-free. It's a 25% difference. So again, understanding the tax code is very powerful for building wealth. So that kind of concludes my more or less what we'll call the lightning round of different tax strategies. And as I mentioned multiple times throughout the presentation, a lot of these I just spoke about for a minute or two. If you think one of these or all of these could apply to your situation, I'm happy to kind of sit down, look at your plan, just make sure we're not triggering anything we didn't think about just off our initial thought. In saying that, I'll see if there's any questions, or there's also the raise your hand feature if you want to say it as opposed to putting it in the chat box. Okay. Well, for one, thank you all for coming. I hope you got some value out of it. Please, 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 always feel free to give me a call or shoot me an email if you want to run through any of the scenarios. But thanks for joining me, and I hope everyone has a wonderful night.